Walk through the private neighborhoods of almost any major city, and you'll find a strange contradiction. The houses are enormous, the cars are expensive, the owners look impossibly rich, and yet, in many cases, the people living there are carrying more debt than most middle-class families will ever see. That seems backwards. We are taught to think of debt as a warning sign, something people use when they cannot afford what they want. Cash, by contrast, feels like real power. Cash is safety. Cash is freedom. Cash is what rich people should want to keep on hand. But billionaire behavior tells a different story. The wealthiest people in the world often avoid selling assets and prefer borrowing against them instead. They take loans rather than liquidating stock. They use leverage rather than sitting on giant piles of cash. And the reason is not just tax strategy, although taxes matter. It is something deeper. For the very wealthy, debt is often cheaper, more flexible, and less destructive than cashing out ownership. To understand why, you have to stop thinking of debt as a sign of weakness and cash as the ultimate financial goal. At the billionaire level, the real question is not how much money do you have. It is, what kind of money do you control, and what happens if you convert it? The answer changes everything. The first layer is simple. A billionaire's wealth is usually not sitting in a checking account. It is tied up in assets, company shares, private businesses, real estate, funds, and equity positions that may be worth billions on paper, but cannot be spent without consequence. Selling those assets creates problems immediately. It can trigger capital gains taxes. It can signal weakness to the market. It can reduce control over a business. And in some cases, it can even move the price against them. Borrowing avoids those losses. If a billionaire owns stock that is worth billions, they can often pledge that stock as collateral and get liquid cash without actually selling the asset. In the United States, this has historically been a common practice among the ultra-wealthy. A loan is not income, so it is generally not taxed the way a sale is. That means the billionaire gets spending power today while keeping the asset intact for tomorrow. This is the first hidden reality. To the wealthy, debt is often a way to create liquidity without surrendering ownership. To everyone else, debt is usually a way to survive a shortage. Same mechanism, opposite purpose. The difference matters because ownership itself is often where the real wealth is created. If you sell stock, you've converted future upside into present cash. If the company continues compounding after you sell, you no longer benefit from that growth. Borrowing lets you keep the upside and still access money now. It is a way of enjoying present liquidity without giving up future appreciation. That sounds elegant, but it only works because the math is asymmetrical. Billionaires generally borrow at relatively low rates because their collateral is strong and their creditworthiness is extraordinary. Banks will lend against assets like public stock, real estate, or concentrated holdings because those assets are visible, valuable, and often easy to monitor. For ordinary borrowers, debt is expensive because risk is expensive. For a billionaire, risk is often lower in the eyes of the lender. So the cost of borrowing can be much lower too. And once debt becomes cheap, another hidden advantage appears. Inflation can quietly reduce the burden over time. A fixed-rate loan taken today is paid back with dollars that may be worth less in the future. If the billionaire's assets continue growing faster than the borrowing cost, the spread works in their favor. In effect, they are using other people's money to keep assets compounding while repaying with depreciating currency. This is one reason wealthy people often see cash differently from everyone else. Cash sitting idle is not just safe. It is also unproductive. It earns little. In periods of inflation, it can lose purchasing power. For someone with billions in assets, holding too much cash is almost like leaving part of the portfolio in a slow leak. It creates no compounding, no control, no leverage. There is also a control issue that most people underestimate. Cash is liquid, but it is also finite. Once you spend it, it is gone. Borrowed money, by contrast, is temporary. If used correctly, it can be repaid without requiring the owner to break up the core asset base. That means the billionaire can preserve the machine that generates wealth while using debt as fuel for specific needs. acquisitions, investments, business expansion, philanthropy, or personal spending. This is exactly why corporate balance sheets often look very different from household balance sheets. Large companies use debt all the time, not because they are desperate, but because debt can be efficient. If the return on investment exceeds the cost of borrowing, leverage increases equity returns. A private investor who understands this may behave similarly. The richest people in the world are often playing a version of the same game at a larger scale. But the real story is not just that debt can be useful. It is that cash can be surprisingly inefficient when your wealth is already concentrated in appreciating assets. Imagine two people. One has $100 million in stock and no debt. The other sells $30 million of stock to buy a mansion and hold cash for spending. The first person borrows $10 million against the stock instead. Both get liquidity, but only one preserves the full asset base. Over time, if the stock rises, the borrower benefits from the full appreciation while the seller has permanently reduced exposure. The cost of that cash is not just interest, it is lost future growth. This trade-off becomes more powerful and more dangerous when assets are volatile. If the market falls sharply, collateral values can drop, and lenders may demand more security or repayment. That is the risk billionaire borrowing hides in plain sight. Debt is only elegant when asset values remain stable enough to support it. If they collapse, leverage turns from a tool into an accelerant. That is why the preference for debt is not the same thing as loving debt. It is disciplined use of debt under favorable conditions. Billionaires are not avoiding risk. They are choosing a different kind of risk. They often prefer balance sheet risk over tax loss, opportunity cost, and forced liquidation. In other words, they accept financing risk to avoid ownership dilution. There is also a behavioral layer here that changes the picture. Cash can tempt people into inertia. Once capital sits idle, the pressure to deploy it productively often disappears. Debt creates an obligation. That obligation can be constraining, but in business it can also sharpen decisions. It forces assets to work harder. The wealthy often value this because the greatest danger to concentrated wealth is not spending too much in a single year. It is allowing capital to underperform for a decade. Still, it would be a mistake to romanticize billionaire debt. The same leverage that magnifies returns can magnify losses. Many fortunes have been damaged by overborrowing, especially when assets were illiquid or overvalued. During financial crises, debt reveals its true nature. It is not free capital, it is a claim. The lender always gets paid first. If asset values fall too far, the owner may be forced to sell at the worst possible time. That is the hidden downside the public usually sees only after the fact. So why do billionaires still prefer it? Because for them, the best version of debt is often less costly than the best version of cash. Cash has a visible cost that is easy to ignore. Taxes, lost compounding, lost control, and inflation. Debt has a visible risk that is easier to fear. Repayment. But in the right hands, and with the right assets, the first set of costs often exceeds the second. This is where the broader lesson emerges. Most people think wealth is about accumulating more cash. Ultra-wealthy people often think in terms of asset control, optionality, and timing. Cash is a tool for living. Debt is a tool for preserving and amplifying ownership. That is why the richest people are often willing to appear highly leveraged, while remaining extraordinarily wealthy on paper. The debt is not the goal. The preserved asset base is the goal. And once you see that, you can understand why many billionaires use debt for philanthropy, acquisitions, and large purchases. If they donated or spent cash from asset sales, they would give up the future growth of those assets. Borrowing lets them convert a portion of future value into current use, without dismantling the engine that created the wealth in the first place. That does not mean this strategy is available to everyone, or even wise for most people. For households without appreciating assets, debt usually does not buy time and control. It buys pressure. The wealthy can use debt because they have the asset base to make it efficient. Without that base, borrowing is more likely to become a burden than a tool. So the real answer to the question is not, why do billionaires prefer debt over cash? It is, why would they give up ownership, tax efficiency, and compounding just to hold more cash than they need? Once you see the hidden math, the behavior stops looking strange. It starts looking rational. The uncomfortable truth is that cash is not always king. For billionaires, cash can be the expensive option, especially when it comes from selling assets that are still growing. Debt, when used carefully, allows them to keep their wealth working while still unlocking liquidity. That is why the richest people often borrow instead of sell. And that insight reaches far beyond billionaires. It reveals something fundamental about modern finance. Money is not just about how much you have, but about what it costs to access it, what you must surrender to get it, and whether your capital is compounding or standing still. The world's wealthiest people understand that distinction very well. Most of the rest of us are still taught to see debt and cash as simple opposites. They are not. In the right context, debt is a strategy for preserving the future. Cash is often the price of giving it up,